So welcome to the weekly Dino session. If you've been here before, welcome back. If you haven't, real quickly, just for guests and those watching the recording, we break this into two parts. One part is a kind of review of the week, and we'll do that for a few minutes. And then the other half is kind of some psychology philosophy about some topic. And today's topic we will talk about in a couple of minutes. It's about paradigm shifts. And it just so happens I like to use topics that are things I'm doing or that are personal to me at the moment. And this one is because this is something I'm actually working on. So we'll talk about that in a few minutes. But before we do that, let's do our weekly recap. Here we are on my structural context view monitor over on the right. And basically today was interesting. I was talking about it while we were waiting for the session to start. It's been very volatile. We've been on both sides of the range pretty aggressively. And, but if you zoom back just a bit, these TPO views, you can see we're pretty much just kind of litigating this range up here that, we came off the lows and in all cases, the strongest off the lows obviously was NQ. The weakest off the lows was RTY. It's still at the lows. The other ones, ES and YM, varying degrees of off the lowness, but clearly they're battling to hold this new little range that we formed. And you can see it on all four indexes. I've got these broken into the overnight and the regular sessions, and new little range, and it's above the old one, but it's below the previous one. Surprise, surprise. That's what it's been doing for months. And YM is consolidating right on its old range. It's been the most reliable, but it's also had some weakness from the banking stuff and from the consumer durable stuff. So it had a lot of volatility earlier this week and last week. And then, of course, RTY has been the weak one because of the little regional banks there's a bunch of them in RTY, and because of the little mini banking crisis we're having. So that's kind of the range picture. And, I feel like a broken record because I keep saying the same thing over and over again, but the ranges are important. When we get to the edges of them, there tend to be really good trades outside in, and occasionally breaking inside out if you get into those early enough and can see them coming early enough through context or structural cues or whatever you're using for that, standard deviations of the volume of the VWAP. ATR, those are all valid ways of determining if we're at extremes or not. And when we're at extremes of the range, it's relevant because those are becoming really good opportunities. I mean, they're always good opportunities, but under this set of conditions, the opportunity in them gets better because what we were talking about at the very beginning, we get this rubber band effect at the edge of ranges, and it just, wicked snaps back one way, wicked snaps back the other way. And that's, particularly as a scalper, that's very tradable. And that's the other thing I feel like a broken record about. Momentum is king. The range is really important under these conditions, and, look for extremes of the range. That's where the best opportunities will be, or the best odds anyway, thinking in bets. And then, just be mindful that momentum is really important. If we get going one way, we don't just stop on a dime. And when we do, that's the rubber band. So, believe it or not, this kind of action for my style of trading is more predictable than, what people like to focus on, like trends. I think trends are very hard to trade. I think this stuff's very easy to trade. So what else is going on? Well, we've had, in terms of the equities that we're derivatives of, there's been mixed news, and, we had the Fed meeting, and we had, all kinds of stuff going on. We've had some earnings reports, the picture overall for the week. And again, that's kind of our purpose here every Friday. We're not, the bear market crashing every day, every week, crashing lower lows. We're not seeing that, but the market clearly, when there's a reason, can sell off very hard. And so it continues to be news and event driven. And when when the panic hits, one of the other things that we've seen over and over again is that there are buyers under the market. They're just not there right on the edges. The ranges blow through the extremes, and then all of a sudden buyers come in out of nowhere. And guess what? That's because there's a lot of money on the sidelines that has no place to go, and money that has to go somewhere, like the kind you see in equity funds. They have to buy. They're almost all long only, and a lot of them are in a chunk of cash. So they're looking for things to do. That's why we saw tech really strong last week when the financials were breaking down. The funds were rotating out of one sector into another, and that can create pretty dramatic price moves. And obviously, if you're trading NQ, we had some really good NQ trading in the last couple of weeks because of that very thing, because money was rotating in and out of tech. So where are we now? Well, we're in kind of this the third day of value, and let me explain that. Whenever there's a big news event, particularly FOMC that we had Wednesday, but other examples, NFP, stuff like that, any of the I's, PPI, CPI, those things. It tends to take 3 days to understand the impact on the market overall, and for value to be determined. The first day, we get the reaction. That's what happened Wednesday. We had the FOMC, we reacted to it. The day after that, we get the reaction to the reaction, and it's often a reversal. And we saw that was yesterday. And then today, it's kind of like, okay, we have balance now. And, and last month it was unique because 3 days after FOMC, we had NFP, and that really shook things up. Today, there wasn't that much going on. There was a little bit of chit chat and some numbers right around the open, but by and large, today looks like it's value getting priced in. And if you just look at the TPO view over here, let's blow it up and get in and just a little bit closer. And, the market is kind of happy here. We went down low, we ran out of gas, we made a nice tail, and we came back up into the volume. And so, this looks reasonably symmetrical. In other words, it's a normal bell-shaped curve. The other thing that I noticed that was really interesting, if you look down here on my ES 30-minute one, I break this into the Globex and RTH. This one on the left is RTH, the one on the right is Globex. And if you add them together, you get, 24 hours. And that's what I have over here. And we filled out this volume really predictably this morning after we opened. But we're pretty much settling down there, despite that little run we just had up to the top. So this kind of looks like a long liquidation, on a Friday, which could set up a very interesting short squeeze, or we could just close down here somewhere. So join me. That's a quick sales pitch for the Friday closing session, an hour before the close. In other words, 3 o'clock Eastern, 12 my time here today. This could be an interesting one, just if nothing else, because of the volatility at both edges of the range. It's been pretty good. So anyway, that's kind of my take of what's going on. I think we're going to see more of the same. I think the market's still trying to get more information, and the Fed wasn't particularly clear about how they're going to handle inflation and a banking crisis. They've kind of been tiptoeing around that. The solutions oppose each other. That's the problem if you're not familiar with that. If you have a banking crisis, you need to put money into the system to stop inflation. You need to take money out of the system. So, it's a complex problem. And economics is an art, not a science, which is a really, really good segue into topic number 2. So I'm going to start segging my way into it. That's the wrap up on the weekly stuff. I don't think there's that much else to talk about other than, the market needs to hold down here. Again, this low held, but boy, if it breaks down again, then I'd say the previous one's in jeopardy a lot more, because we just haven't bounced very much, and that bid underneath the market might go away for a while. So bad news could open up another burst down. Who knows? But so far the market's digesting news pretty predictably, with just overrunning extremes a little bit at a time, and I think that's the most noteworthy thing. So let's talk about topic number 2. So if you looked at the announcements yesterday and this morning when I posted the actual topic, I wasn't trying to be snarky. When paradigm shifts, how to create them when you are leveling up. That's the topic. Paradigm shifts, how to create them when you are leveling up. So let's talk about that for a minute. First of all, what's he talking about? All right. Well, paradigm shifts is a fancy term. A paradigm is a model for something, and a paradigm shift is when things change. When suddenly things change. If the end of the world, that's a paradigm shift. Anything catastrophic shock to a system can cause one, but it's just a change in the general underlying assumptions. For example, computers use binary math, zeros and ones. It's either on or it's off. If suddenly, all computers were quantum and there were, you know, it could be on and off at the same time, that would really mess up our binary computers. They need it to be either or. There's no yes or both to binary. You can't say, well, it's on, but it's off, and that's what a quantum computer can do. And that's why they're so powerful. Way oversimplified, obviously. To make a point, I'm oversimplifying. But where I'm going with this paradigm shift discussion is that as traders, we seek paradigms that work. You're looking for a model that works. You're looking at an indicator that works. You're looking for a setup that works. Those are paradigms. Those are predictable approaches to a set of conditions where the same thing happens over and over again. And if you were to have a paradigm shift, that would either stop working or you would change how you work it. And generally, traders are very much programmed. And here's my big point. So fasten your seatbelt. Traders are generally focused on not changing the paradigm, get it right, and then never change it. And there's some wisdom to that, but like most conventional wisdom, it's only a little bit of wisdom. Most of the wisdom is on the other side of it and the opposite of it. So let's break that apart a little bit. Once you have something that's working, you need to protect it vigorously, and not do it differently and keep doing it the way that works and not change it because it works. But sometimes you want to change it either because you have to, because it stops working. That's the most obvious one. And then the other thing that sometimes happens is you have what I'm going through right now, where it's working and it's working well, but it's boring and you want it to work better. And you can see some ways it could work better, but you want to avoid some pitfalls of just improving it in conventional ways. So that's a big mouthful, but I will deconstruct it and explain it next. So the first thing we're looking for is, how to create a paradigm shift. So what I'm saying here is I want to create change. And that could be messy and that could cause trouble. And the reason I want to do it is because in this particular case, I want to scale up. Okay. And it's very easy as a trader to think of scaling up as, okay, well, I'm trading 2 micros right now or 2 minis or, whatever. And I'm trading, 2 micros or 20 micros or 2 minis or whatever your math is. Okay. It's easy to just say, well, if I want to scale up, I'll just multiply that, so if I was trading 2, I'll trade 4, I'm scaling up. Just keep doing the same thing. Conventional wisdom tells you that's right. And from a maths point of view, it is right. But guess what? Markets aren't always about math. If they were, they wouldn't need you. You're there because markets have an element of art. And art is emotional, and you can't just apply math. And this is why so many engineers make decent trading models, but they can't trade for shit because they can't think in terms of art. They can't think in terms, if what's the limit? If the limit is this price, then it can't go past that. Yes, it can. Edges are there to be overshot. That's the whole idea of an auction. Push the limits, push them too far. Think Hunter S. Thompson. It's the most fun is at the edge, going over the edge. That's where life is. That's where you enjoy it. Well, trading, that's where the big opportunities are. That's where it's asymmetric. So let's talk about this for a second. I just went through this, and so there's the thing. I was trying to scale more, and in the past I've scaled just by multiplying. All right, I've been trading 1, I'll trade 10. I've been trading 1, I'll trade 5 or whatever. And that generally works. It's not that doesn't work, except there's a massive flaw in that. There's a massive flaw in that. Can anybody guess? And then now I'm going to throw it out to you now that I've introduced it that way. Can anybody guess where I'm going with this? What is the flaw in that kind of thinking? What does that disregard? That I'll give you a big hint. What does that type of thinking disregard? Risk. Okay, well, that's always a good guess, David. But how? Everything's about risk. Variation. Ooh, Todd's a thinker and he's absolutely correct. But variation where? You disregard risk and momentum. Okay, that's correct. But again, the question's where? Todd says draw down. Okay. Run out of runway. Ooh, Donnie, do you have a background as a pilot? Because I'm a pilot's license guy, although not current license, but I have had one now. Okay. Because that's a common way for a pilot to look at the situation. And you're close, but we're not quite there. Okay, David's saying variation in self-management of the trade. Ooh, you're getting close. Everybody's, Maria nailed it. Conditions. Bingo. And everything you guys said is right in some way or another. But the word I was looking for was variation. That's why Todd was right. And variation in conditions. That's it right there. Variation in conditions. There are times when you're scaling, when if I have 100 contracts available, I should take all 100. I shouldn't just go from 1 to 10. I should go from 1 to 100. But if I do that at the wrong time, boom, there goes the account. And maybe if I'm copying, there goes 10 accounts. And I was struggling with this because the value, and again, there's two sides to this. Scaling more contracts, scaling more accounts at the same time because I'm copying. So this is a complex equation. And the variation in conditions is what really dictates the right answers. And it took me a while to figure out not only what the right answers are, but to even understand what the right question was. And so here's an example. There's times of the day and there's certain conditions, and there's certain conditions about me to the things that David was saying. That's totally true. My focus at the moment, for one example, if you look at all those things and you say, okay, I'm just going to scale up, how can it not be catastrophic? Because if you think about it, if let's say you do it either way. Let's go from trading up to 5 lot in one account, and then now let's copy it to 10 accounts. Okay, so it's basically a 50 lot, but you're spreading the risk out. So that's manageable, except under one situation. And the one situation is if you make a significant mistake, you blow out your statistical model, but you blow it out times 10. And you don't spread the risk times 10, you spread the damage times 10. And boom, all of a sudden, something that's worked really, really well can wipe out not only one of your accounts, but all of them. And I kept experiencing, I wasn't wiping accounts out, but I kept having really big events like that hit everything. And I kept saying, okay, there's something wrong with that risk management. It can't just be about scaling, because scaling is only part of it. So, and this is the art. Again, if you just apply math, you can't solve the problem. You have to think about it. And you have to say, okay, under what conditions does it make sense just to go bigger? And under what conditions does it make more sense to stay small and spread the risk out? Well, if you think about that, it has to do with not the risk of the trade, but the risk of the catastrophe of the trade. Think about that for a second. When I'm looking at each trade, I always have, and I've talked about this in the risk management series that's in the library, I always have in the back of my mind the worst thing that can happen. But that thing isn't multiplied times 10 in my head. And so if I'm copying to more accounts, it's really not times 10. It can be more like times 100, because the reason you're spreading out is to minimize risk across multiple accounts. But in the catastrophe situation, you're doing the opposite. And that's the only exception to that, but it's a really significant exception. So the way I started playing around with this, I was trading my quote unquote 25K accounts. Actually, it was they're $1,500 drawdown trailing is what they are. And I can make those profitable, and I can make them profitable every day. But I get bored at that level. I can't get big enough on the size and whatnot. So I'd get all those into withdrawal range, and I either withdraw them or shut them down, or I started playing with scaling them. Well, what if I just trade 20 of them at a time? I can just $50 a day in each one. Kind of what Maria's been doing and Amy's been doing, and this makes some sense. But the problem with that is you can't really go big if you're doing that. You have to keep the size small. I can't say, all right, I'm going to put on 40 lot in each one of those. There might be a justification to do it, but you can't do it anyway, even in a perfect setup, because it's systemic risk. It's not risk to just that trade. It takes out your entire system, all the accounts you're copying to, and it wipes you out. And that isn't something that your mind factors in when you're looking at the catastrophe of the price risk. And that's the key right there. So I'm considering all of this and I'm thinking, all right, this is very interesting. How do you optimize a model like that? So let's go back to what we're trying to do. So now let's go back. So we're talking about example. Let's go back to theory. What's more theory about how do you invent a paradigm? How do you invent a new way of doing something? Well, step number one, you have to question your assumptions. In other words, how are you doing it now? Or as one of my mentors once explained to me, oddly, this was during a ceremony with psychoactive mushrooms, believe it or not, but he explained to me, questioning your assumptions is really, really important. And it can be really hard to do because you have to really, anything that you're made of, you have to disassemble it. So the way that this mentor put it, and I always remember this because it's really important, he said, think of it like cooking. You have to change the ingredients. You can't just heat it more, longer. You have to change the ingredients, and that's really hard to think about when you have, well, the soup's pretty good right now. I don't want to mess it up. You have to mess it up. That's the definition of a paradigm shift. You have to change the ingredients, and that's what you need to do in your head when you're doing this. So one of the things I said to myself right away was, okay, so one of the assumptions of a swarm is, and if you don't understand the swarm term, that's also in those library sessions. One of the assumptions of a swarm is that the more extreme you get, the more aggressive you get. And that makes a lot of sense. But it's disregarding something right up front. How aggressive do you get at the beginning? And that's where the conditions matter. So I started testing something since I moved in 2 weeks ago here, and it's been working extraordinarily well. I'll tell you that, and I'll talk more about this later because this is a Dino, and I'm just getting to the psychology of this. What I started doing was I made some new rules. I am no longer allowed to enter a trade with a one lot. I have to use, in this case, 2 or more. So that makes you much more discriminating about where you start your swarm. Okay, so that immediately has adjusted to the conditions. We've adapted to the conditions by making that one change. The next thing is I have to scale faster, harder on my new swarming model. I can't say, all right, I'm going to add to this 30 points away. In the new model, it's really aggressive at the right spot. And guess who I'm learning this from? This goes back to the student becomes the teacher with Video Game Guide. This is what he does. He waits more patiently than I do, but then he gets a better setup and he starts much more aggressively than I do. He doesn't nibble in. He says, if you're going in, go in. And I'm like, yeah, but nibbling helps me sense the market. He says, then nibble bigger and get a better sense. This is me and Video Game Guy talking. And he's right. So I'm going in with more size. And if you look at the results I posted in the pit this morning, I have many, many fewer trades with bigger size. It's not a huge amount of size. It's just more. And instead of, making 20, 30, 50 bucks at a time, there's a bunch of 100, 150, 200, 240 at a time. With a tiny increment of size and a lot fewer trades, and the total amount of trades is actually less. So less is more at the right spot, and then more is more. And that's the conundrum for building a new paradigm. So you have to question your assumptions. You have to change the ingredients. So the first ingredient I changed was that. I said to myself, okay, and he helped it make sense for me, which is you got to start bigger. And that's going to force you to be more discriminating. And then you have to be more aggressive over a smaller area. That's why his MAE is so low. And that also makes swarming more difficult because you get in bigger faster. So if you're wrong, you have to really be good at getting out of the way fast. And fortunately, my win rate's really high. So I can afford to be wrong more. And this is something one of my other coaches pointed out to me. This isn't, Video Game Guy doesn't coach me, but one of my coaches pointed this out to me. He said, you're always complaining your win rate's too high. So that's okay. Then you don't need to worry about that. You obviously don't need to worry about being wrong. You can be wrong more. So go for it. I said, yeah, but that's going to give me big losers, which is, that's my problem when I do that. I overthink, I get overconfident. And he said, well, that's why the idea of going in bigger in a smaller area makes sense. It's forcing you to be more precise. So you're not scaling only by the number of contracts, you're scaling by the number of contracts, and a paradigm shift as to how aggressively you're going to play those, with the understanding that if you do this poorly, you're going to lose more money than you were losing before. But if you do it well, you're going to make exponentially more money because it takes advantage of when you're right. And that made a lot of sense to me. Again, this is my mentor playing this back to me. So step one, you've got to question your assumptions and rip out the ones that aren't helping you. The idea of swarming is a really powerful risk management approach, particularly in a volatile instrument like NQ. But a lot of people, particularly new people, use it as a license to add to losers. So this also helps mitigate that, because you have to go in bigger. You can't get away with that. You have to admit losers quicker. And so the net result is it's a really powerful incremental improvement, but it's a completely different paradigm. And so just to summarize really quickly, just to review, and then I'll take questions or comments and I'll say a few other things about it. The new paradigm is really simple. You have a lower minimum and you have to scale more aggressively. And I'm only doing it in a max of 2 accounts now. I'm not copying to all of my accounts. Therefore, the other accounts are never at risk. Since I made this change, and I've been doing it both ways, basically, I've been trading it one day one way, one day the other way. The days that I've been trading it on the new paradigm are averaging about 3 times the P&L of the days I'm trading the old paradigm in this current volatility, which takes advantage of the new paradigm. And it also makes the losers smaller with the new paradigm, because I'm going in aggressively and I'm much more keen about getting out when I'm wrong. And because I'm not wrong very often with my win rate, I'm not seeing that enough. So I can be more and more and more aggressive. So I'm getting more and more profit. And I'm not losing yet. So big losers aren't happening because I'm so dialed into the fact that if this goes wrong, it ruins the 2 accounts at least I'm trading in it. But I also have more comfort because I know that, yeah, I'm not spreading the risk out at the moment across 10 accounts, but I'm also not risking blowing them up. And by the way, I'm doing this in 50K accounts, quote unquote, $2,500 drawdowns. And there have been several setups that I've gotten well into the amount of contracts. I've traded 50, 60, 70 micros, and not even by swarming. I've done some 1+1s with 25 and 25, and I had one of those in the overnight the night before last, and it was like a $400 trade with micros. This is MNQ. And I thought, okay, that's a lot better than a $40 trade, which I thought was really cool. If I woke up and I'm on my way to the bathroom, oh, I can make $40. Now I'm on my way to the bathroom, I can make $400. It's much better. But I can't just look at that and say, oh, now I'm trading 10 times what I was the last time I went to the bathroom. The conditions have to justify it for it to make sense. Hopefully, sorry, I'm with the bathroom story. I just thought that was funny because that's true. It is actually true. I sometimes do that. All right. So anyway, that's kind of the right on the bottom of the hour, the Dino thing is, if you're going to create a paradigm shift, and you may not want one. Sometimes, when you're new, if you have it working, you just want to keep it working. But understand conditions change and you need to adapt. And everybody has to scale at some point, because we all have to start small when we're learning, and we all have to get better as we get bigger because the risk is higher. And so this was just kind of an interesting, I don't want to call it a wake-up call, but it was once again an example of where I saw the intersection of art and science in trading, where just applying the maths or the science doesn't work. You have to question the assumptions, and you have to change the ingredients. And sometimes you make soup that tastes like shit, but sometimes you come up with really, new soup that's really good. It's better than the old soup. But you have to force yourself to that. To make that happen, and that can be hard to do, particularly when it's working well. I was having routine $1,000, $2,000 days with those old numbers and the old paradigm, but with this and roughly the same number of accounts, even fewer accounts, math says, I haven't done it yet because I've been working on this for 2 weeks, but math says they could be $10,000 days with the exact amount of, actually with less trading. That should be how that works out. Of course, time will tell, but it's on the right track anyway, is the point. So I'll get to questions and comments in just a second, but I wanted to just share one more thing to you. And this is one thing that's really, this is a great quote. This is a Hunter S. Thompson quote. And this applies to paradigm shifts. You have to do this to create a paradigm shift. Sometimes they're created for you. The things just change and you have to adapt. But what I just put in the quote in the chat there, Hunter S. Thompson said this: the edge. There's no honest way to explain it because the only people who really know where it is are the ones who've gone over. And that's just so true. If if you've ever had any sort of, and almost everybody has had some extreme experience in life. That I had a stroke when I was 27. I almost died. That wasn't the first one of these I had. Crashing my first big crash in motocross, I was 15. That was probably my first life and death event. And I was like, whoa, I'm not invincible. And then a week later, I was acting invincible again. It took me a few decades to figure that one out. But anyway, so that's my Dino thoughts. And let me read some of the comments. Let's see, Maria. This is really helpful. A few weeks ago, I took apart my process, but when I put it back together, it came out about the same. I couldn't figure out how to change, improve it. Exactly. That's what I was doing. I was getting really bored with $1,000 a day, and I really wanted to step it up, and I really wanted to think differently. So I just ripped it apart. And I spoke to my mentors. That's always important. The people that aren't afraid to call you on your own bullshit and help you check your assumptions and help you change the ingredients. And it was really profound for me. There's a lot of times I'm trading the same amount now. I'm not scaled, but when I scale completely differently. Even though the maths concept is roughly the same of swarming. I'm still swarming. I'm just the way that I execute the swarm and the conditions under which I will enter to swarm are different. They're improved, they're better, and they're producing better results. And that's the way it works. Better process creates better results. Let's see. Yep, that's so true, David. This is really true about you. I see this in my individual work with you. There's no question. This is something that could impact you if you think about it this way. And we've talked about a few examples of that. Wouldn't this style of aggressive trading be different than the one plus? Oh, absolutely. See, the one-to-one approach is a way of teaching somebody how to scale and not add to a loser. That's what the 1+1 is about. Listen to what I just said and play that back. The 1+1 is about teaching someone how to scale and add to a trade without it being add to a loser, because you have to have thought about it in advance. Where would I add? Where would that make my position average be? And is that a favorable place to have a position right now under these conditions? It forces you to think ahead before you make the decision, which is the idea. But the problem with the one-to-one thinking is it's not very adaptive. Because, what if you trade to your price number 2? And this is exactly what happens to you, David. You trade to your price number 2, and at that point, there are conditions under which adding, even though it's there, is a bad idea. Maybe the trade's disintegrating, or the order flow in your favor is deteriorating, or whatever it is, or you have a hunch, this is going to go a lot lower. So sometimes a better decision is to go flat there, not to add it, but your mind is in, well, I'm doing a 1+1, or you start thinking about swarming, when that's the place where you just say, you know what, I'm wrong. And again, that takes a lot of practice. So that's why I divide my risk management teaching and the way I approach it myself into, a simple add, one place I want to trade and one place I like even better for a simple, 1+1 or 2+2 or whatever. And then small swarms, those work really well if you're right, but they don't give you a lot of payback because you're small swarming. You're only putting on 5 contracts or whatever. So the paradigm shift here is saying you can still small swarm, but start with 2 and take it to 10, but only do it when the range is really tight. Otherwise, you might get run over, in which case you should be thinking about a big swarm. And does this situation justify 100 micros? And if so, does it justify getting in with 10 of them right now? If it does and it starts to work right away, then it's a really profitable trade. But if we get 20 or 30 or 40 of them, it should immediately be a better trade. And that's the difference when I'm doing these. I always say good trades work right away. when I'm doing my quote new paradigm, they work right away because I'm scaling in harder and being more patient for the right places to scale in harder. And if it doesn't justify it, I'm not going in at all. I'm getting better entries and they're working even faster. So that's why if you were at my session on Wednesday, I caught 2 or 3 really wicked good runners. I mean, like 30 or 40 point runners in NQ. And I did that in about 11 trades that I did live. And the reason I was catching the runners was because I was kind of demonstrating the thinking of that paradigm shift there. I was doing it there. I was being a little more aggressive and I was doing it right away. But I didn't want to do too much with that because I didn't want to just focus on profitability. I was trying to explain, what I was teaching Friday or Wednesday, which was the open. So anyway, and think about this. So basically I'm getting 2 to 5 times an improvement in the results right now. And instead of scaling 10x, like I was saying, do the same thing in 10 accounts that I was doing in 1 account. What I've done is I've made a very adaptive form of scaling, and I'm doing it in only 1 or 2 accounts, max 2. That's part of the paradigm shift. No more than 2 accounts. That way, I always have 8 left. If I have 10. In this case, I do 10. Funded or qualified or whatever, and I could even get that up to 20. But the idea with this approach isn't why trade all 20 of them at a time. Yes, that spreads it across more accounts, but when you have a catastrophic failure, it wipes them all out. And so that's not that's way bigger than a catastrophic failure. That's Armageddon failure, and your brain doesn't factor that in unless you really have planned that out well. And I think that's one of the reasons they push copying so much, because it's seductive. The numbers get really big when you're winning, but you have to manage the risk differently, and your paradigm has to be different. And that was the message of this class. It's not that there's no need to nibble, but a nibble is a more significant event. So you better nibble more precisely, David. It's about precision. Okay, so Bar, go bigger and admit you're wrong faster. Yes, exactly. And so, but again, this only works for someone that has a consistent, smaller, scaling slowly edge. If you're still getting blown out with big losers, then you have a different problem. You have the problem of not admitting you're wrong, which you need to work on. This will help you work on it by making your losers really dramatic. That's the point. Does that make sense, Bar? Let's see. Donna's saying, I add to winners. You might think there's not another place to enter, but there is. It's not that, Donna. It's in the futures market, and I know you come from other markets as well. In the futures market, adding to winners is only justified if it's trending strongly. Otherwise, what you're actually doing is making your position less favorable, and that can have a negative impact on your P&L. So I only add to winners when the momentum is really strong, and yeah, that's perfectly justified there. But then your break even's coming up. It's getting worse. So anytime it can't get anywhere near back to that, or you're basically leveraging yourself out of your profit. So be very careful of that. But you are correct. And that's why, the conventional wisdom, never add to losers. Well, remember, swarming isn't adding to losers. Swarming is saying, where would I like to have 100 contracts on? Okay, we're not there. But are we close enough that it's worth 10 contracts to try that we are exhausting? And often it is. And so you have to scale appropriately to the quality of the opportunity. And in other words, appropriate to the quality of the asymmetry of that particular example of setup. Not the setup overall, and not every setup like that. Every ledge break's different. Some of them are much more asymmetrical. We're down 500 points, 3%, and we're at SD4. That's pretty asymmetric. Most people are, I'd trade that very light. Jeff and Lee are like, no, that's a full boat. That's everything you've got. Because if you're wrong, it's really obvious, it's already so extreme that you don't have to be very right to make profits with a lot of scale. And so, that's a paradigm shift. But again, you have to be really confident in your ability to read extremes. Otherwise, you're coming with your 100 lot and, the market gaps down another 100 points and then it locks limit and you're stuck in your position. And guess what? Speaking from experience, that's happened to me in YM. I actually got lock limited once in a 20 lot, not MYM, but a 20 lot YM position. I was scalping a ledge break and I was offsides and they locked it. And so, anybody that was trying to cover the other way could cover, but there was nothing I could do because there was no market. Luckily, the news overnight shifted a bit, and when it reopened, a lot of the gap that I'd been caught in was revisited. So I only lost about half as much as I could have, but that was an interesting lesson about fading. Be very careful fading markets when, and this is for those of you learning from me right now, this is a key point too. Fading when you're anywhere near extremes, lock limit extremes, not SDs or LRCs, but places where the market will halt. That totally ruins your day. The last thing you want to do in a lock market is, be on the side of the market that can't get out, because that is the worst kind of trap, and there's absolutely nothing you can do. And brokers often make massive margin calls when that happens. You might think, oh, I've only got, 5 micros on, but you're trapped in that position, and you've only got your little $2,000 account. Your broker might call up and give you a $15,000 margin call or close your account with the loss. That they have the right to do that. So it's really important to understand the ramifications of some of those things. All right, anyway, so that's kind of the end of the Dino topic. I hope that was an interesting topic. Paradigm shifts and creating your own change is a really fascinating topic altogether. But in trading, it's really important to understand there's times when you don't want to change anything. When it's working or you're learning it, or you don't have any, potential to improve it. But other times, you have to kind of crack the system and try to put it back together better. And sometimes that doesn't work dramatically. Look at Mercedes in Formula One right now. They just cannot get that car to work for 2 years in a row now. But that doesn't mean they're not going to try. And I wouldn't be shocked if you're a Formula One fan, by the way, that maybe at Silverstone, we might not see a totally new Mercedes. They might just revamp that concept altogether. They have time and money to do that. So anyway, let's see. Very profound. Thank you, David. I agree. Let's see, Bob. There seems to be a tipping zone bounded by where your directional call defines the edge. Oh, you're on this again. The apex conversation. Okay. And where the aggressor's intent becomes painfully apparent. I find swarming at this tipping zone is once very tempting and very dangerous. See, to me, Bob, the ideal place is to let it tip and then come roaring in the other way. That's what works the best for me. So I look at those zones and I say, I don't want to be all in here, because if this goes, it's going to be really dramatic. And that's where I want to jump in, because that's where the rubber band effect happens. Do you understand what I'm saying, Bob? Because this is a critical point. It's not that apex, but it's the exaggeration away from that apex. That's the big opportunity, and particularly in NQ, MNQ, CL. You can't, executing on it takes a lot of practice. Maybe that statement should be, I do, but I can't execute on it yet. I wasn't able to do that 5 years ago or 2 years ago. I'm constantly looking for ways to improve and constantly looking for new tools. And, there's a lot of really cool stuff coming from Emoji, the Emoji bot technology, and Lee's upcoming release, where you can build bots to help you execute against those things. And then, just turn the bot on and let it do it. That example of a price breaking really dramatically is a really good example of where Lee's bots are perfect. No matter which way you're trading that, whether you're fading it or going with it, that you need something executing right next to the exchange that's not going to have to think about it. It's just going to look at the conditions and do it or not do it. And that might be a way to do that. Maybe create yourself a little bot, or at least in the process of creating the bot. And I know JVC will echo this. Creating the bot, you'll learn a lot about your thinking about what has to happen and where you do what against what's happening, right, JVC?
Say the least. There is nothing to force clarity onto what you're thinking like making a bot. And I would say that 99 times out of 100, the clarity you gain from it is actually, okay, wow, my thinking has a huge flaw here.
Exactly. Exactly. And so what do you do? It's a paradigm shift. What you're doing is you have a paradigm you're trying to code into a bot. A paradigm is a pattern that just repeats over and over again. And so you're trying to make a bot to do that. And in the process, you realize that, hey, this thing that I think happening over and over again doesn't quite happen the way that I think it does. And so you learn even more about how it does happen. And that way you figure out how to execute against it. So this is a perfect example, Bob, to your situation. And again, the other side of it is, as a human, it's about practice. I'm not using any bots. I trade totally 100% manually, discretion, clicking with my mouse and my 63-year-old arthritic fingers, and it works. So sometimes I misclick and whatnot, but there's a lot of stuff I played around with automating for decades, in Bloodhound and in, you name the bot code out there, I've tried it. And I'm looking forward to seeing what Lee's doing too. I've been watching the beta about this. The only problem is I have to do it in Sierra Chart, which I really hate. Sierra Chart, just every time I have to interact with it, I want to blow my head off. It's like, anyway, okay, so good comments, good questions. It's a fun topic. Every now and then, force yourself to shift your paradigms, even if for no other reason, to try to prove to yourself that the way you're doing it can't be improved. And this applies to life also, people. This isn't just about trading. If you don't like the situation, your paradigm, where you live, your job, what time you go to work, what time you come home, all that's the only way to change that is to change the ingredients, and that doesn't happen without pain. You have to force that to happen. You have to push that. You have to get uncomfortable. You have to go over the edge, like Hunter S. Thompson said. And you'll know it when you do. If you're not feeling uncomfortable, you're probably in your comfort zone, and you're probably not questioning your assumptions, because the process is uncomfortable. I promise you. I've done it infinite times by choice and not by choice. And it's never comfortable, but it's always productive. So I will leave it at that. All right. Thank you for attending, Dino, this week. We will see all of you for the close, or all of you TRG members, otherwise for the Sunday reopen. Have a good rest of your Friday. Remember, don't try to make your week on Friday. Number one, never, ever, ever fade a really, really, really strong Friday close, because you will get run over, because everybody tries to fade them and gets run over. But also understand that Friday extremes can be very interesting to fade, as long as they aren't short squeezes, which are absolutely go with it and scale up and add to winners as fast as you can scenarios. We could get that today. Today was volatile enough. We are back up above the initial balance now. Real quickly, let me wrap with one quick screen share, and just to put a point on this about the close. This close could get real interesting. So as that's loading up,
we've got it.
There we go. Okay, cool. Yeah. So as that's coming up, this is over here, the blue lines, initial balance high and low. Look at this. We're almost at SD2 now again. We're almost at the ledge in ES, YM, and RTY. NQ's a way off of it. So, but in terms of the Globex extremes, we're right at SD2 and ES. We're just filling the gap. We've been trying all session. This is the gap here. Same story in NQ, but it's not nearly as strong. It's in the middle. So the close could be very interesting. So join us for the closing session, and we'll trade that if we continue to have a good setup. All right, with that, we're out of here. Thank you, JVC.
No problem. See you at the close.